Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light with episode number 10 entitled Helicopter Drops on Main Street. Please! Exclamation point. Okay, let's get right into it. The helicopter drop, that is when a central bank prints money, gives it to a national government to spend, is what Stanley Fischer, the former vice chairman of the U.S. Federal Reserve Board, that's our U.S. central bank, former governor of the Bank of Israel, former professor at MIT, former professor at the University of Chicago, has recommended helicopter drops. He did so in August of last year in a paper presented through the auspices of BlackRock, the world's largest money manager, and I'll put a link in the description box. Now, what's interesting is he recommended resort to helicopter drops for a central bank long before this malady, which is facing the developed world, which I won't mention by name because apparently it gets your YouTube blocked. But we are facing in the developed nations a very serious prospects of a deep recession in the first quarter, first half, and possibly entirety of 2020. It is precisely this type of episode that Stanley Fischer would recommend a resort to helicopter drops. So there was an interesting article came out a few weeks back by an interview actually by an economist named David Beckworth. He's associated with the Mercatus Center at George Mason University, kind of a right-wing readout of economic thinking. And David Beckworth was interviewing Frances Coppola, who is not the old movie director, U.S. American movie director. She's an observer of the British economic scene. And David Beckworth, who has also come out in favor of helicopter drops, asked Frances Coppola about quantitative easing back during the Great Recession of 2008 and 9. Quantitative easing is when a central bank, that would be the Federal Reserve, buys bonds on globalized capital markets. So back then, the Federal Reserve bought a lot of treasury bonds. They also purchased something called mortgage-backed securities. But going forward, it would be mostly treasury bonds that the Federal Reserve wants to buy. And it is thought this helps preserve asset values, pushes down interest rates a little bit, preserves bond values. But as I've noticed in previous episodes, episode number 5, when I discussed Stanley Fischer more at length, you have $400 trillion in global capital markets, and money is a fungible commodity. So how much quantitative easing actually accomplishes has been debated. And extra debated if it does anything to stimulate demand within the confines of the United States, that is Federal Reserve quantitative easing. So there was an interesting conversation that David Beckworth had with Frances Coppola, and she said, when that transmission mechanism is broken, as it was after the financial crisis, that's 2008, the helicopters can only fly over Wall Street. And what you need is somebody to fly them over Main Street. So at the same time as you get a lot of money really going into Wall Street one way or another, hovering up assets and replacing it with money, you've got Main Street suffering from thirst. That was back in 2008-9. But what she's referring to is a traditional central bank tool is to lower interest rates. Banks lend more. You may wonder, well, where do banks get the money to lend? Well, they print it. I've explained this to non-economic friends, people with PhDs in chemistry, and they think I'm making it up. But here's what happens. You go to get a loan from a bank. They have $1, say, in deposits. They'll lend you $7. Where do they get the $7? They print it. And that's how the economy used to be stimulated back when interest rates were, say, 5 or 6% higher than they are now. Of course, now they're at zero anyway. So that mechanism for stimulating the domestic economy is rather weak, as is trying to stimulate an economy through quantitative easing, the buying of bonds in globalized capital markets. It just doesn't work. What does it do? So what? Bond values go up a little bit. What does that do? That doesn't do anything in terms of demand inside the United States. So this mechanism of helicopter drops, recommended by David Beckworth or Stanley Fisher, Adair Turner in Great Britain, sometimes known as Lord Adair Turner, appears to be what more and more macroeconomists are gravitating to. Now, the problem in the United States, we don't have that authority. The Federal Reserve does not have that authority to print money and give it to the federal government. It can print money and put it on Wall Street. You can help Wall Street. You can't help the U.S. government, and you can't help the U.S. worker through helicopter drops. There might be one mechanism which can work. As recommended by the Trump administration, we could have a holiday on payroll taxes. Workers would have the money, they could spend it. Businesses would have the money that they don't pay in taxes, about 15% of payrolls in total. They could spend it or keep workers on payroll. And the Federal Reserve could buy more treasury bonds, and some people say that would actually be a helicopter drop. There's a Michael Woodford, Columbia University, who contends that federal deficit spending in combination with a helicopter drop, in combination with quantitative easing, is really a helicopter drop. I think he's right if you get the size of deficit spending larger, and a federal payroll tax cut would do that. I would even recommend the Federal Reserve simply print money and place it into the Social Security Trust Fund. It's just laughable at this point that we can say the Federal Reserve can print up trillions and trillions and trillions of dollars, and it has no inflationary impact, which it did not have after the 2008 Great Recession. But to print up $800 or $900 or $1 trillion and put it into the Social Security Trust Fund would be horribly inflationary. And besides all that, now is not the time to talk about inflation. Now is the time to talk about how to keep people on the jobs and boost demand within the United States. So this is your tinfoil hat economist signing off at the speed of light. I look forward to seeing all of you again in episode number 11, in which we will further examine macroeconomic policy in the age of a global malady.